Hey guys, this is the first in a series of 3-minute videos that demonstrate the use of Grayline's sales and trading models to price, analyze, and present interest rate derivatives. This video is entitled, What Happens When You Open the Model? We start by opening Grayline's Excel demo. Immediately, the model goes into calculation mode. It's entered the first default structure into the input screen and begun solving for the fixed rate on a swap that matches the rate on the loan, including all the retail charges. The loan credit spread, of course, the credit charge, capital charge, collateral charge, external charges, and the profit. At a certain point during the short calculation, charts appear on the screen. They show the title or a description of the swap in the upper left, the ROATE credit approval and retail rate in the upper right, and a pie chart that breaks down the components of gross revenue. 3 of the components are further illustrated on the right in 3 charts: potential credit exposure in green, lifetime collateral required in red, and the capital charge calculations in purple. Now that the calculations are complete, let's look at the items on the right-click menu. I right-clicked on the mouse and I see Grayline's custom menu on the top of the standard Excel menu. The first item is default structures. Selecting that reveals 8 potential structures or templates that may serve as a starting point for structuring a hedged loan. You don't need to start with a default structure. You can enter the loan inputs and copy from the loan to the swap using this menu choice, or you can enter the inputs in the swap and copy from the swap to the loan. Either way works, and the swap and the loan are independent of one another. Once you've entered your desired loan and swap structure, you'll see the calculated mid-market price, mid-market rate, and you need to calculate, if you want the retail rate, you need to calculate the exposure tables. And that's here on the menu. The lifetime swap exposure table will calculate the appropriate charges, the credit charge, capital charge, collateral, etc. And it will add those charges to the base swap rate to show you a retail swap rate. It's already been calculated here. The short-term swap exposure table is optional. In contrast to the lifetime exposure, which calculates the value of the swap at each month end from the as of date, that's over here, to the maturity of the loan, that's here. The short-term exposure calculates the value of the swap every day, daily valuations, from the as of date to as many as 360 days hence. And you can enter those right here or put a date to which you want to value the short-term exposures. In the process of calculating the exposure and the resulting retail swap rate, the model calculates the rate for amortization to achieve specified payment of principal and interest. That specified type of payment is defined here. And this goal seek can solve for that rate for amortization independently. We will highlight the data and curve fitting menu in a later video, but these choices let you control and manage incoming raw data and create smooth forward curves. Show input help, as you can see, reveals explanations for each input cell on the screen. By clicking this and then selecting any cell with blue text, you may see what kind of information is being used for each of these inputs, and that's very helpful. You can then turn it off if you're not interested. Last, on Grayline's custom menu, Manage Indications allows you to save and ultimately recall indications and maintain a historical database of saved indications. That's it for this video. To learn more, visit our website, graylinepartners.com. That's one word, GRAYLINE partners.com.